We're looking at the Jefferson case study on private wealth management. Let's scroll down and read that first question. Based on the Jeffersons' financial goals and current portfolio, what would be the most appropriate strategy to ensure they have adequate liquidity for their short-term goals while optimizing their tax situation? So we've got A, invest more heavily in equities and use the returns to fund short-term goals. B, maintain a significant portion of their portfolio in cash and short-term bonds. Or C, use a combination of tax advantage accounts and tax loss harvesting. All right, let's start reading and see what their goals are, and we can kind of compare that to our options here. John and Emily Jefferson are a married couple in their early 50s with 2 children, ages 20 and 17. John is a successful entrepreneur who recently sold his technology business, while Emily is a marketing executive at a major firm. The sale of John's business brought in $15 million, which they invested in a diversified portfolio of equities, bonds, and alternative assets. They have an additional $2 million in retirement accounts and $500,000 in joint savings account. The Jeffersons have several financial goals: funding their children's college education, and so we've got their 2 children are aged 20 and 17, so this is pretty near-term goals. So this is potentially one of their short-term goals, ensuring a comfortable retirement. So they're in their 50s, so retirement's a little further out for them potentially. I mean, they certainly could retire now with that business sale. And then establishing a charitable foundation to support education and environmental causes. John and Emily are concerned about the impact of taxes on their investments and are looking for strategies to optimize their tax situation. They also want to ensure they have adequate liquidity for their goals and manage their financial exposures holistically. Okay, so I think we've gotten to the point where we need to. So we have these shorter term goals, main one being the funding kids' education. This is something, based on the age, it's probably something they're doing in the current moment. So what do we want? What's the most appropriate strategy to kind of optimize for that goal? So A, invest more heavily in equities and use the returns to fund short-term goals. Equities are going to be for longer-term goals, so something like retirement or potentially for this charitable foundation. Not short-term goals, because we have volatility, which could lead to negative returns in the short term, which would be a bad thing for funding short-term goals. So we'll rule out A. B, maintain a significant portion of their portfolio in cash and short-term bonds. So this is where the balance part comes in. If we maintain too much of the portfolio in cash and short-term bonds, the risk then becomes not having enough money to fund the longer-term goals. So this might be good for funding children's education, but inflation and spending is going to eat away at that nest egg if we don't invest that money. So we're going to rule out B as well. Let's make sure we feel good about C. So C, use a combination of tax advantaged accounts and tax loss harvesting. So optimizing the tax situation, tax loss harvesting is also going to do that. And then if they use a different combination of tax advantaged accounts, but also taxable accounts, which is what it would be implied by tax loss harvesting. They're not yet able to pull from their retirement accounts. So if they have taxable accounts, that's going to ensure they have kind of the ability to pull on that money without any penalties and whatnot. So we'll go with C for answer number 1. Question 2, what tax management strategy would best suit the Jeffersons' diversified portfolio to enhance their after-tax returns? So I think we've already read up to this point here, and I don't think we need to do any more reading for this question, so we'll read these answers and make sure we can answer it. So what they want to ensure, so from the reading, they want to optimize their tax situation and ensure they have adequate liquidity. So we're talking about the tax part here. So what can they do to enhance after-tax returns? So to enhance after-tax returns, we need to minimize taxes that we're paying and basically defer as long as we can. So A, focus on low turnover investment strategies and tax efficient funds. These two things will minimize taxes. So if we have lower turnover, that's going to mean less capital gains in any given year. And if we have tax efficient funds, that should also lead to less gains and dividends. So A seems like a good candidate so far. B, frequently rebalance the portfolio to capitalize on short-term gains. We do not want to do this because if we're capitalizing on short-term gains, that means we're creating more taxes. And specifically for short-term gains in the U.S., short-term gains are taxed at a higher rate than long-term gains. So rebalancing frequently and realizing short-term gains is going to be bad. That'll lower our after-tax returns. And then C, allocate a larger portion of their portfolio to tax-exempt municipal bonds. This is going to avoid taxes, but it may not be optimal for growth that they need to hit these goals up here. So we will cross that off and go with A as the best answer here. Question 3. How can the Jeffersons most likely evaluate the success of their investment program in supporting their retirement and charitable foundation goals? So let's read a little bit more. We left off at holistically. They met with their financial advisor, Sarah, to discuss the financial plan. Sarah recommended a goals-based approach to align their investments with their objectives and proposed several strategies to optimize their tax efficiency. Sarah also advised them on the importance of maintaining liquidity. Okay, so I think this paragraph here is kind of mainly what we're talking about here. So we're taking a goals-based approach, which means that we're basically going to invest our money in such a way that it's allocated, that it kind of lines up with each of these goals. So we might have a certain investment allocation for the college education, and then we might have a separate allocation for the retirement, and then a separate allocation that's kind of earmarked for this charitable foundation. So it specifically asks about the retirement and charitable foundation goals, so let's read these answers. A, by tracking the annual returns of their portfolio and comparing them to market benchmarks. So this is not really the purpose of goals-based investing. For goals-based investing, we want to hit our goals. So we're not necessarily tracking our portfolio relative to some benchmark. I mean, it's important to be aware of that to make sure your specific funds or ETFs or securities that you're using aren't drastically underperforming and not helping you to not reach your goals. But the point of it is not necessarily to kind of beat the market benchmark. It's to make sure that our investments are growing to meet our goals. So we'll rule that out. B, by assessing whether the portfolio growth aligns with their financial goals. That's kind of what we just said and what we were just talking about. We're going to set the allocation based on the amount of risk we want to take for each of these different goals, and then kind of track that growth to make sure it hits that. So I think B sounds like our answer. Let's make sure we can rule out C. By focusing on the reduction of tax liabilities and the growth of their tax advantage accounts. This goes into the part about optimizing tax efficiency, but it's not necessarily, that's kind of something they want to do as a part of the strategies, but not necessarily that's not necessarily part of the goals-based approach, which is aligning the investments with objectives. So we'll rule that out as well, and we'll stick with answer B. Question 4. How should the Jeffersons most likely allocate their assets to meet their retirement and philanthropic goals, considering their risk tolerance and investment horizon? Let's read this last paragraph here, which we haven't done yet, and then we'll answer this question. Sarah also advised them on the importance of maintaining liquidity to meet their short-term goals, such as funding college funding, while ensuring their long-term investments remain aligned with their retirement and philanthropic goals. So that's kind of ties right into this question. How do we allocate assets to meet these longer-term goals, and then consider the risk tolerance and investment horizon? So A, allocate a larger percentage of the portfolio to high-growth equities and private equity. B, invest predominantly in fixed income and low-risk assets. So I think we can go ahead and rule that out right away. If we're investing in too many low-risk assets in fixed income, especially for a long time horizon, which is for their retirement. They're, like we said, they're in their early 50s, so let's assume at least 10 years for that. That's a pretty long time horizon. And philanthropic goals will likely span beyond their lives. So that's an even longer time horizon. If we're too invested in fixed income and low risk assets, we risk the risk becomes not meeting those goals because our growth didn't kind of keep up with the money needed to fund those goals. And then looking at allocating a large percentage of the portfolio to high growth equities and private equity. That doesn't sound like a bad idea because we do have a long time horizon, but let's kind of read C and then determine which is better, A or C. So C, balance the portfolio with a mix of equities, bonds, and alternative assets. This seems like the most prudent approach. The retirement goal is 10-ish years away. So it's a decently long time horizon, but I think that equities are generally thought of as like a 10, 15, 20-year duration, especially private equity. Your money could be locked up for 10 plus years in that instance. So they may need some liquidity for retirement within 10 years or so. So we will lean towards going with that balanced portfolio, answer C.